Good afternoon, ladies and gentlemen. My name is Nati Teller. I will be taking you guys through chapter 14, which is the treatment of uncertainty and risk in decision making. Exactly what we'll be looking at this afternoon. If you were to just rewind and go back to chapter 5 and chapter 6 of your textbook, if you go back to P1 and you just think about what we covered in chapter 5, chapter 6 and chapter 7, we're focusing on short-term decision making. And as you progress to P2, you'll be introduced now to long-term decision making. In those chapters, what we do as an organization, we do a lot of forecasting about what is likely to be the cash flow in the future. And given that cash flow that we may have projected as an organization, then we ask ourselves, how confident are we in the cash flow that we have projected? And how risky our assumption? How confident are we in our assumptions? And then we find ourselves then moving to ask a very important question, to say, if I have projected that next year I'm going to be generating 1,000 Rand in revenue, how confident I am that this revenue is going to be achieved? Am I 50% confident? Or am I 80% confident? Or I'm 100% confident? Therefore, if we are 50% confident that the 1,000 Rand will actually be achieved, then we're saying the best thing that we can do whenever we're doing a forecast is to use 500 Rand, which is 1,000 multiplied by 50%. However, if we are 80% confident, then we're saying we must take 1,000 multiplied by 80%. By so doing, we are factoring the level of confidence into the cash flow forecast that we have done. Therefore, in chapter 14, there are quite a number of things that we'll be actually looking at. Number one, we need to look at how do we factor risk into decision making. Number two, we want to assess the different types of attitudes that some of our managers that are in charge of making decisions will have. What type of attitude do these people have? We'll also look at the value of information. We're saying if you have information, you will be in a privileged position compared to somebody who doesn't have information. And then we'll move to look at decision criteria as well as decision tree. Then if we go back to what we've just been talking to and then reflect on the introduction, which then provides us with the content and the context in which we'll be looking at risk and uncertainty. Okay? Number one is saying the next few chapters will explore some decision-making problems, such as whether to launch new products, whether to buy a machine, choosing between products. We've already explored some of these elements in chapter 6, where we said, do we source a product or a component externally, or do we make it internally? But other decisions that will need to be made by the management team of any organization, it involves or revolves around whether we need to launch a new product or we don't have to launch a new product. Another decision that we may need to make, it's around whether we should reduce the amount of dividends that we're declaring or we should increase. Sometimes when organizations are faced with so much pressure, then they will obviously consider reducing dividends or not paying dividends at all. But if the management team is considering reducing dividends, one of the key risks that they face, or another uncertainty that they will face, is what will be the reaction of the share price? Will the share price drop by the same percentage in which the organization will be reducing the dividends? it will go worse than the percentage that we'll be using to reduce the dividends. That's uncertainty. Therefore, management teams need to make decisions in the context of an uncertain environment. We are just trying to paint the picture and provide you with the context in which we need to consider risk and uncertainty when it comes to decision making. Therefore, what we want to do right now is to provide you with an explanation of what risk and uncertainty actually are. How do I define risk and how does it differ from uncertainty? Therefore, number one, we're saying risk, it's defined as follows. It's what may actually go wrong. Risk, it's what stands between you and your objectives. Your objective is to increase your revenue from 1,000 rand in 2016. In 2016 you had 1,000 rand. Therefore now for 2017 you want your revenue to be 5,000 rand. What is it that will stop you or will stand on your way from achieving your set objective? That which will stop you from realizing your objective is known as a risk. Are you guys with me? Therefore, it's very important then that you fully understand what risk is. And quite often then, we will need to measure risk by applying probabilities. Therefore, we say the probability of us achieving 5,000 rand is only 60%. Which means the organization then is likely to achieve 3,000 rand. Because we must take now 5,000 multiplied by 60%, which means the probability of us achieving the 5,000 is 60%. Therefore, multiply 60% with 5,000, it will give you 3,000. That is what you are likely to achieve. But these probabilities that we are talking about are based on historical information. We will say, based on our experience, we have launched a similar product in the past, and this is how the market responded to the launch of the new product. Whereas, if you are looking or you are talking about uncertainty, we're saying we have no experience of how the market will respond to the product launch. Therefore now, when it comes to uncertainty, you will not be able to apply probabilities. Therefore, that's the difference between risk and uncertainties. With risk, you have probabilities that you will assign to an event or to an activity. But with uncertainty, you're not going to have those probabilities. Therefore, what then we want to calculate when we are applying probabilities? We want to calculate what is known as an expected value. What is expected value then? We're saying an expected value, it is the long run weighted average of all the possible outcomes that are likely to happen in the future. Therefore, expected value then, what it does, it summarizes all the different possible outcomes by calculating a single weighted average value. And how do we go about applying or calculating expected value? The way we will calculate expected value, there is a formula which then is presented as expected value is equals to the sum of your probability multiplied by future outcome. Therefore, we say expected value, it is the sum of all probabilities, multiply them by your possible outcome. Therefore, let me give you an example. If we are considering launching a new campus in Witbank, we will say, based on history, there is a 20% probability that there will be 50 students that will join IMAS. But there is a 60% probability that there will be 100 students that will join IMAS. And the remaining 20%, there is also a 20% probability that actually will have 200 students in Wheatbank. Therefore, what we're saying, number one, you need to take the probability, multiply it by the possible outcome. The possible outcome here is 50. If we will say 20%, which is the probability, multiplied by 50%, then how much are we going to get? You're going to get 10 students. Number two, 60% probability multiplied by 100 students, that is the possible outcome. Therefore, that will give us 60 students. And then there's a 20% probability that we will have 200 students. Therefore, we're saying the outcome is going to be 40%. Then go back to your formula. Your formula said expected value is calculated as the sum of the probability multiplied by your possible outcome. Therefore, now it means we must add the 10 plus 60 plus 40, which gives us now our expected value as 110. That's very important. That's how we calculate our expected value. Are we comfortable? Awesome. Just to wrap up, that 110 that we calculated then is what we will call or refer to as your long run weighted average. Is what you are likely to have if you were to launch a campus in Wheatbank, and that is very important. Second example, we are having an organization that is contemplating launching a new product. However, this organization will only launch a new product if the expected value of the total revenue will be in excess of $1,000. This organization has decided to set the price of this new product at $10. After some investigation, a number of probabilities for different levels of sales revenue are predicted and are shown as follows. You are likely to sell 80 units. If the price is $10, then 80 multiplied by $10 is going to give you 800. 100 multiplied by 10, it's going to give you 1,000. And then 120 multiplied by 10 is going to give you 1,200. But what you need then to understand is that for every single option that you've been given, there is a probability assigned to that particular option. The first option, we said you are likely going to sell 80 units, generate a revenue of 800, and the probability of that happening, it is 15%. Therefore, take your 15%, multiply by the $800, and you're going to get 120. That is the possible outcome. Okay? The second one, you will take 50%, multiply by $1,000. And what is that going to give you? That is going to give you 500 in terms of the possible revenue that you're going to generate. And then lastly, you're going to take 35%, multiply by $1,200, and that will give you 420. Because we said expected value, it is equals to the sum of the probability multiplied by the possible outcome. Therefore, now let's sum what we've already calculated. 120 plus 500 plus 420, it's going to give us what? A revenue of 1040. That's how we do it. Therefore, what is expected value? We're saying it is the weighted average of the possible outcomes is what we are likely to achieve in the long term. Are you guys with me? That is very important. Then now, if you look at what we've presented on the slides, we're saying in preparing forecast and making decisions, management may proceed on the assumption that it can expect sales revenue of $10.40 if it sets a selling price of $10 per unit. The actual outcome of adopting the selling price may be sales revenue that is higher or lower than the $10.40. Why are we saying that? There's a 15% likelihood or probability that we can only generate 800. But also, there's a 35% probability that we will generate 1,200. And hence then we are saying, what is more likely? It's a plus minus 1040. It's not 1040. Can either generate 800, 1,000, and 1,200. That's what you are likely to generate. And hence then we're saying, the 1040 is not even the most likely outcome. The most likely outcome is 1,000 because the probability is 50%. That's what is most likely to happen. Are you guys with me? Most likely because of the probability of 50. What is it that you are most likely to achieve when you are considering the probability? Is it something that has a 15% chance or something that has a 50% chance? You have a bigger chance of getting 1,000. And hence we're saying what is most likely is to get 1,000. Okay. If you don't get it, feel free to give me a shout. Okay? The second example that we want to consider, it's an example where they say a company has identified 4 possible outcomes from a new marketing strategy as follows. Outcome A is likely to give you a profit, or they're saying option A is going to give you a profit of $100,000, but the probability of that happening is only 10%. Therefore, what is the chance of getting 100,000? It's only 10%. Then option B, 70,000 will be the profit, but the chance, the probability of getting 70,000 is only 40%. Option C, there's 50,000 profit, but the chance of achieving that is only 30%. The last option, which is option D, we are likely to make a loss of 20,000. And the chance or the probability of making a loss of 20,000 is only 20%. Then now what we need to do is to calculate the expected outcome of this strategy. Therefore, what we're going to do now, we're going to take the possible outcome of each option multiplied by its probability. Therefore, 100,000 multiplied by 10% will give you 10,000. 70,000 multiplied by 40%, therefore that will give you 28,000. Then 50,000 multiplied by a 30% probability, that will give you 15,000. Then lastly, option D, it's a negative 20,000 multiplied by 20%. Therefore, that is going to give you negative 4,000. Therefore, if you sum all of these to get your expected value, then now we've got to add. It's 10 plus 28 plus 15 minus 4. Therefore, the expected value of this strategy will be $49,000. That is the long run weighted average profit of each of the possible outcomes. Which mean in the long term, we're saying if this scenario keeps on repeating itself, the organization is likely to make 49,000. But it's very important that I repeat the same point that I made when we're doing example 1. We're saying this is the weighted average. But what is likely to happen? It's one of these 4 possible outcomes, which means we are likely to make a loss of 20,000 or to make the highest profit of 100,000. These are likely outcomes. Then if the question says to you, what is the most likely? You look for the possible outcome that is attached to the highest probability, which in this case, the highest probability is 40%, which means what we are most likely to make, it is 70,000. But the 49, it is the average of all the possible outcome multiplied by their probability. Are you guys with me? That's very important. Here is a previous exam question that we'll need to consider to test if you guys fully understand this concept of probabilities or of calculating your expected value. If you look at this question, okay, it was written in November 2013. Therefore, let's read the required first. They're saying prepare a payoff table showing the profits for production quantities of 40,000 tons, 60,000 tons, and 80,000 tons. Number one, what we want to explain to you before we get into the details of this question is what is a payoff table? What is a payoff table? If you go to your textbook, in chapter 14, if you are doing P1, however, if you are doing P2, the chapter for risk and uncertainty, it is chapter 12. Therefore, now let's start by looking at chapter 14 of P1, because the very same concept, it is presented in both P1 and P2. And the content that is covered is exactly the same. Therefore, if you are doing P2 and you're watching this video, don't worry. Therefore, if you go to your textbook, if you look at section 4 of your risk and uncertainty chapter, you'll find on section 4, we're talking about payoff tables and decision criteria. What then are we saying there? We're saying when evaluating alternative courses of action, management's decision will often depend upon their attitude towards the risk. To consider the risk borne by each alternative, it is necessary to consider all the different possible profits or loss that may arise. Therefore, a payoff table is simply a table that illustrates all possible profits and losses. That's what it is. Therefore, if you go back to the previous chapter, what you were actually given as option A, B, C, D, you were given the profits and their associated probabilities. Therefore, that is a payoff table. Therefore, in this question, you are asked to put together a payoff table. You are not given the payoff table. Therefore, you should be in a position to determine or to put together the payoff table as a student. This is how then we're going to do it. Let's read the question first. They're saying a company produces grit for use on public roads during icy conditions. The grit has to be produced in advance of the winter season. The level of demand depends on weather conditions, or we're saying the level of demand depends on weather conditions. Any excess production has to be disposed of, as it will deteriorate before the following winter. The company has received the following weather predictions and associated demand for next winter. Therefore, you are told if the weather condition is severe, only 72,000 grit will be demanded. However, if the weather is normal, 54,000 tons of grit will be demanded. And if the conditions are mild, 38,000 tons of grit will be demanded. The company needs to determine the quantity of grit to produce for the next winter season. It can only produce 40,000 or 60,000 or 80,000 tons of grit, and cannot change the quantity once production has begun. 1 ton of grit has a selling price of $150, and the cost associated with that, it is $70. Any unsold grit will need to be disposed of at the cost of $20 per ton. Therefore, what are we asking you to do is to put together the payoff table. Therefore, let's see how we're going to put together a payoff table. Then number one, we've got to consider that on our vertical side, on our vertical side, we're going to have our demand. Saying the demand can either be what? 72,000, or it can be 54,000, or the last option, it can either be 38,000. However, the production can either be 40,000, 60,000, or 80,000. Therefore, if production then is 40,000, what will happen here? What will be the profit that will be determined or that will be generated by the business? Because we're saying we've got to show, a payoff shows all possible profits or losses that will be generated. If then the organization produces 40,000 units and the demand is 72,000, it means the company will be able to sell everything that they've produced. Therefore, they told you that the price is 150 and the cost associated with it is 70. However, any unsold grit will be sold for $20. Therefore, in this case, except when we are selling, when the demand is actually 38,000, that's the only time you'll have any unsold grit. Therefore, let's look at 72,000. Therefore, you're going to have 40,000 multiplied by your profit. The profit will be determined by looking at $150 minus 70. Therefore, if you say 40,000 multiplied by the difference between 150 and 70, the difference is what? 150 minus 70, it is $80. That is your profit per each ton of grit. Therefore, 80,000 multiplied by everything that you will have sold, which is 40,000. Therefore, the most likely profit that you're going to generate, it will be 3.2 million. If you've produced if the demand is 54,000 but you've only produced 40,000, what will be the profit? It's the same, because it's 40,000 multiplied by the $80 per ton of profit. Therefore, here as well, you're going to make 3.2 million. However, when you produce 38,000, if the demand is 38,000, but you've produced 40,000, then it means you're only going to sell 38,000. Therefore, it will be 38,000 multiply by 80, that will give you 3.04 million. However, there is now a difference of 2,000 grit that is unsold, and that is determined by saying 40,000, which is what we've produced, minus what we've sold, which is 38. For there's 2,000 tons of grit that has not been sold, and we're told that any unsold grit will be sold at what? At $20. Are you guys with me? Good. But there's one mistake you mustn't make. Remember, the unsold grit, it also has its own cost. It cost us to make it $70 per ton, and there's a $20 per ton that we will incur to dispose it of. Therefore, now we must say the cost of $70 multiply by the 2,000, not, it's a 2,000 tons, okay, of grit. We're saying we take the cost of 70, multiply by the 2,000 units or 2,000 tons of the grit that is unsold. And also we're going to have the scrap value or this disposable value, which then is 20, not rands, we're talking about dollars. Okay, dollars. Okay, we must not forget that we are using dollars here.